This is the Asia Trade. I'm Shery in Tokyo.
And I'm Annabelle. Droulers in Hong Kong. The top stories this hour. The S&P 500 closes above 5,500 for the first time in history. Fed Chair Jay Powell suggests data that the economy is back on a disinflationary path. Tesla shares surged 10% after the EV maker's quarterly sales drop wasn't as steep as expected. And Bloomberg learns China is making and testing lethal attack drones for Russia, a sign Beijing may be deepening its support despite US warnings.
Another record high on Wall Street. What are we talking about? The 32nd already this year. We had consumer discretionary as well as those tech stocks gaining ground. The Nasdaq 100 touching that 20,000 mark. And of course, we're watching yields because we had those comments by Chair Powell really talking about that progress in reducing inflation. Treasury yields were down, although a little bit supported by the fact that we saw a rise in job openings. Let's see if we get that follow through in the Asia session. This is how we're setting up in Asian futures as we have the Nikkei already trading at the highest levels since March. The Japanese yen continues to trade around that 1986 low. So we will see where JGB yields go from here as well. Could we see a little bit of support given that we saw a little bit of declines for the dollar after 6 weeks of gains? We're following, of course, Australia PMI numbers. We also have retail sales numbers today. So a lot on the agenda for investors to digest.
Yeah, but Shery, as you said, it's that focus on what Powell said at Sintra, that forum by the ECB in Portugal, and really the comments that he said around inflation in particular, because he was asked, what keeps you up at night? And he said it was really just that two-sided equation here. On the one hand, you've got to bring down inflation. On the other hand, you really can't risk seriously damaging the labour market. But they are really seeing progress on the CPI front, and that's why he said the Fed can afford to be patient. Take a listen.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. Frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right. And that's what we're planning to do.
Yeah, on that panel, that caution really reflected by President Lagarde as well after the ECB cut rates last month, right? We saw Eurozone inflation actually slowing towards that 2% target, but she's still talking about the uncertainties ahead. Take a listen.
We still believe that it's likely to be a bumpy road until the end of 2024, but we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front.
Let's get more market insight with Jeffrey Kleintop. He's Chief Global Investment Strategist at Schwab. And Jeffrey, talk to us about the risks that you see ahead, because you hear there from Lagarde, for instance, with this warning. But at the same time, you look at where the VIX has been really for much of this year at the lower end of the range, sitting around 12. Does it tell us that investors are just being complacent, or are they justified pushing ahead when you've got the outlook for Fed easing, inflation is coming down, and earnings as well?
On the surface, it does look like their complacency is justified for all those things you just pointed out. We're in a global recovery. Even if U.S. economic growth is below trend, the rest of the world is rebounding from a manufacturing recession last year. Rate cuts are on the horizon, and you still get some pretty good earnings growth. The negative to this is the potential that inflation doesn't come down or continue to fall as it has. I'd point to container shipping rates, which are halfway back to their pandemic peak and are continuing to climb. You know, they filter into everything we buy on the goods side. So the fact that we're seeing a 300% increase in container shipping costs this year, we're back halfway to the pandemic peak there. That's beginning, I think, may begin to flow through in terms of prices over the course of the remainder of the summer. We got real stickiness in service inflation, and the labor market just doesn't seem to show signs of weakening up enough. So there is some risk that the Fed and other central banks may not be able to follow through on those rate cuts later this year.
And so then how do you want to be positioning in that sort of environment if you think, I mean, we've already seen rate cut expectations push back anyway, but if they go into the next year as well?
So I think you want to stay away from those stocks that are most sensitive to liquidity. And I'd point to maybe some of those high-flying AI stocks. Now, I know Tesla had a great run today. Isn't really an AI stock. I guess it could be in a way. But really, if you look beyond what their earnings are doing, their valuations have really become extended. I think that's where you run into some risk if you do have central banks not providing the liquidity that helps drive those stocks later this year. And that's why I would allocate maybe more to sectors that they're sporting more attractive valuations and getting some momentum to earnings, like the financial sector. It was one of the better performing sectors in the second quarter. I think it could be the best performing sector here in the third quarter. Financials are traditional beneficiaries of rate cuts as yield curve steepens and credit demand revives. So if you do get the rate cuts, they may perform well. If you don't, you get those attractive valuations, maybe providing some defense.
Are those attractive valuations in Europe? I mean, we haven't seen a great earnings season for quite a while, but you seem to like European stocks and that they will outperform the U.S. in the next quarter. Why is that?
It's been a long time, but one of the things that's turning around is the brighter earnings outlook for Europe. For the first time in 5 quarters, Europe's earnings growth is about to turn around and grow faster than U.S. earnings growth in the third quarter of this year. They've really been lagging primarily because the incredible growth to earnings in AI stocks, it's about to change. And this is due in part to easy comparisons to last year's recession, but also because of the economic recovery that's lifted Europe out of that recession this year. And of course, maybe those rate cuts as well. So all those really playing into a better environment for European stocks in the second half of this year.
Do the French elections, the UK elections, do they give you some pause, or is political risk something that needs to be factored in, given that we're also headed towards presidential elections in the U.S.?
Well, there's election risk everywhere. Clearly, maybe we're past it in Taiwan, India, and Mexico, but certainly there are a number of elections over the remainder of the year. Look, I think the markets have discounted the risk around the French election and may rebound here as we get closer and beyond it. Maybe with the UK election too, as maybe the outlook clears and the uncertainty goes away to some degree, and maybe fiscal spending side, the concern about budgets really blowing out is maybe a little bit overblown. So I think you could see a revival there, but clearly trade risk is going to be a factor for the market over the remainder of the year. It doesn't matter where you invest, that's baked in. I like those markets where valuations are already low and maybe factoring some risk associated with that. We just don't see that as much in the U.S., where valuations are well above their 10 or 20-year averages.
Well, Jeffrey, where we definitely know valuations look attractive is China, of course. Are you turning a little bit more positive? Because we had seen that momentum, but it's given up a lot of steam.
Yeah, I find it hard to get excited about China without more effective actions to restore consumer confidence, which is at recession lows, and to stabilize the property market. We expect China's domestically focused stocks to lag, given that very weak backdrop, despite their low valuations. And at the same time, rising populism from those elections this year could point to more tariff and other trade barriers that could weigh on the stocks of China's exporters. Now, the pace of exports in key goods like electric vehicles seems unsustainable to me in an environment of rising protectionism. And that suggests maybe some more risk here. I know we saw a bounce in the second quarter. Chinese stocks were among the best in the world. I don't think they're going to be able to sustain that momentum into the third quarter.
How closely are you watching, Jeffrey, what's happening with the PBOC and the potential rewiring of how they provide liquidity at a time when we continue to see bond bulls push the market higher there?
Yeah, I mean, unfortunately, the liquidity is being provided to manufacturers and export industries, and I think they're going to run into excess inventories because I just don't think there's as much demand as they're hoping for. At the same time, domestic demand remains very weak. I would reverse that and focus a little bit more on the energy to reviving domestic demand, maybe putting guarantees in place for would-be homeowners so that they don't think they're going to lose their deposits on some of those down payments they've made on some of those homes, and really bring back the consumer to buy domestically made goods as opposed to trying to stoke more demand from exports by just subsidizing them. I just think it's directed in the wrong place.
Consumption has also been pretty muted here in Japan, and of course the recovery prospects have been weighed down by the fact that we don't have as much domestic demand as was expected. With a cheaper yen and perhaps a more depreciating trend from here on out, could that be a risk for the Japanese markets?
I like the Japanese markets, and I understand the risk by a continuing weakening in the yen, but I'm hoping that begins to turn around later this year. I know I talked about there was risk to the Fed maybe not following through on those rate cuts, but if they do, and we're still penciling in 1 or 2 rate cuts for the Fed late this year as we have all year, there is, again, some risk to it, but that's our view. I think that could bring some relief to the yen, but I really like that Japan's stock market tends to track the financial sector on a global basis. It's our favorite sector for the second half of the year, and we continue to see gaining momentum in the manufacturing sector globally. Of course, that's a big part of what Japan does, and it's right in the sweet spot there. So I really do like Japan's stock market. It's been a great performer, just the yen has really sapped some of that performance. If we can get some stabilization in the yen, I think we'll see Japanese markets really shine.
Jeffrey Kleintop, always great to have you with us. Chief Global Investment Strategist at Charles Schwab. Coming up on the Asia trade as well, Tesla shares rising after the EV maker reported less drastic drop in sales than expected. We'll get analysis with Dunne Insights shortly. We'll also hear why SGMC Capital is reducing its position on U.S. equities to hold despite the strong rally. Plus, we'll get Allianz Global Investors' take on the Chinese bond frenzy. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Well, Bloomberg has learned China is making and testing lethal attack drones for Russia. That's according to European officials that are familiar with the matter. Our China correspondent Min Min Lo joins us in Hong Kong. And Min Min, for quite a while now, China's been saying it doesn't provide any sort of weapons to parties of the Ukraine conflict and that it also strictly controls exports of dual-use articles. But at the same time, this could really be a huge escalation in China's possible involvement in the conflict.
That's right. Well, the Chinese embassy in Washington has so far said that they do not provide weapons to any parties of the conflict. And you're right, they always say that they're controlling that export of dual-use equipment. U.S. officials so far also maintains that China doesn't provide direct weapons and ammunition, but China has been accused of providing these machine tools, components, dual-use equipments. And this time, these European officials, speaking on condition of anonymity, are saying that Chinese companies are testing and developing a version of a drone that is modeled after Iran's Shahed. Now, what is the Shahed? It is known as a sort of kamikaze drone because it's not meant to survive its attack. It can loiter for hours, really locking on a target and then launching a strike. It's been used, thousands of them have been used in the war since the start of the war. It's very cheap to use but very hard to defend against. And this really signals quite an escalation of Beijing's support for Russia if it's true, and it will likely also trigger more forceful responses as well, perhaps sanctions against China. So this is something we want to monitor very closely going forward.
Yeah, it really is that big question mark over the extent to which China is supporting Russia, and some in Europe are saying that Russia is increasingly dependent on Beijing as well. So what's the role of China in this? And Finland, for instance, is saying that it could really end the entire conflict with just one phone call.
Yeah, that's right. So the Finnish president in an interview had said that, well, Russia is so dependent on China that China can just pick up the phone and really get Russia to end that war. And this really reflects the frustration that Europe is really feeling about Beijing's reluctance to do more to end that war. And not only are they doing that, they're also helping Russia to circumvent these sanctions from the West. China has been buying Russian gas and selling it cars. And if you look at trade, let's pull up that table there. China is now accounting for an increasing amount of Russian trade. Last year, it accounted for just under 30% of trade, up from, I think, under 20% in 2021. And that's the opposite in Europe. If we can pull up the table, in Europe, the trade, it accounted for, I think, 17% of trade last year, compared to just over 30% several years back. Have a listen to what the president of Finland had said about China's role in supporting the war in Ukraine.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
The Finnish president having a very strong stance there. He says that Europe needs to shift to a wartime economy and that the European Investment Bank really needs to move beyond its red line to start financing some of this military industry as well.
In the meantime, excuse me, President Xi Jinping landing in Kazakhstan for the Shanghai Cooperation Organization Summit. This is an organization established by China and Russia in the early 2000s. What can we expect from such a grouping?
Yes, President Xi landed in Kazakhstan not too long ago, and he's going to meet with President Putin again. That will be their second meeting in about 2 months, because Putin just visited Beijing back in May, and the two sides had hailed their relations and pledged to deepen economic, military, and political cooperation. And it's not just Putin who will be attending, according to Chinese state-linked media Global Times. The Belarusian president will also attend for the first time, marking an expansion of the SCO membership if Belarus joins as a full member. That's after Iran joined as a member last year as well. And in 2017, India and Pakistan joined as members as well. So this really marking an expansion of membership to up to 10 members if Belarus joins in. China likely to hail this as the growing relevance of the SCO organization to the world as part of China's campaign to really build towards this multipolar world order. Economics is likely to be on the agenda, and geopolitics as well, that war in Ukraine, given the recent developments about China developing that drone to assist Russia in the battlefield.
Our China correspondent Min Lo there with the latest on those geopolitical tensions. But these are some of the other stories that we're following at this hour. The sentencing for Donald Trump's New York hush money case has been delayed by 2 months to September 18th. This is so judges can review the impact of a landmark U.S. Supreme Court ruling about presidential immunity. The sentencing would come less than 7 weeks before the likely Republican nominee's rematch against President Biden. Trump faces up to 4 years in prison for the criminal case. About 116 people were killed in a stampede at an overcrowded religious event in the northern Indian state of Uttar Pradesh on Tuesday. It's one of the deadliest such incidents in decades. The death toll includes mostly women, as well as 7 children and a man. The stampede took place after the crowd rushed toward the preacher to seek blessings. More ahead on the Asia Trade. This is Bloomberg.
South Australia's capital, Adelaide, is considering converting empty office spaces into apartments as it seeks to fend off a housing crisis. But as Paul Allen tells us, the plan is not without its challenges.
The for lease signs are everywhere in Adelaide. The problem is it's the wrong kind of property that's vacant. According to the Property Council, 1 in 5 office buildings sit empty in South Australia's capital, while less than 1 in 100 residential properties are available for rent. That's one of the lowest vacancy rates in the country. These two housemates are in a familiar situation, facing eviction because their landlord wants to convert their home to short-stay accommodation for more money.
He's planning to Airbnb our house out and has only offered us, he's increased our rent and then only offered us a 6-month lease.
The solution seems obvious: convert empty offices into apartments, otherwise known as adaptive reuse.
Whilst it's good to have new builds, it seems a terrible waste not to deal with the old property we've got. We've identified another 150 or so buildings that we think have the potential for conversion.
It's an inviting idea, but repurposing these kinds of spaces for living is not as easy as it seems.
The really big challenge is finding the right office building to convert. A building that's got the right floor-to-floor heights, a building that's not too deep and that is slim enough, and a building that's in the right location.
And then there's the matter of finding an investor willing to take on the cost and the risk. Growth is sluggish in Australia, and inflation is still above the Reserve Bank's target band. Not only is it pushing rents higher, it's pushing building costs higher too.
Whether it's improving office stock as is, or embarking on what is a huge challenge in adaptive reuse, office to residential, the environment currently in the city isn't one that's conducive to taking on more risk.
Finding cost-effective, elegant solutions to Australia's enduring housing crisis isn't easy.
We'll get more about Australia's housing squeeze in a couple of hours' time when building approvals numbers for May are released. For now, let's get Paul Allen to discuss this because, Paul, we have been talking about this housing squeeze in Australia for quite a while now. What are we expecting in terms of those building approval numbers and the overall trend, I guess?
Yeah, well, those building approval numbers for May are expected to increase by 1.6%, but given some of the macro factors here in Australia, you wouldn't rule out a downside surprise. And we did have a contraction in April, and in fact, if you look at the whole year-to-date data, apart from an expansion in March, building approvals have been contracting all year. So we've got an environment here where rates are elevated. There's no sign that the RBA is going to ease anytime soon. We also had that stickier than expected inflation number for May, the monthly CPI coming in at 4% as well. And as the Property Council mentioned there, not a great deal of appetite in terms of taking on risk for things like adaptive reuse right now. So the demand's certainly there. Rents are soaring, not just in Adelaide, but in other major centres as well. We saw with the CoreLogic house prices this week that Sydney house prices have just hit a record as well. But even if we do have building approvals numbers spike today or perform well, there's long lead times here. It takes a long time to bring on new properties. So there's no fast solution to the housing crisis in Australia.
Yeah, and Paul, not just the building numbers, we're getting retail sales as well. And to say that they've been not looking too crash hot could be a bit of an understatement as well.
Yeah, sluggish pretty much seems to be the theme in Australia at the moment. We are expecting an expansion there as well of 1/3 of 1%. But again, I don't think anybody would be too shocked if we had an undershoot on that number either, because in the same month, May, as I mentioned, we had inflation accelerate to 4%, which surprised everybody. I mean, we've got the usual suspects here as well. We've got high inflation, we've got high rates, and even in its minutes yesterday, the RBA said that there is evidence of growing financial distress among Australian households. And the Australian Bureau of Statistics, which puts out these numbers, has also noted that consumers are really starting to cut back on discretionary spending. Things might get a bit more interesting in the second half because, of course, this week every Australian got a tax break. There is some sense that maybe we'll get some easing later in the year, but right now conditions looking pretty tepid.
That was Paul Allen in Sydney as we count down to those key numbers due from Australia later today, but we'll have more ahead on the Asia trade. This is Bloomberg.
We're watching Tesla in after-hours trading after we saw that huge jump in the New York session of gains of as much as almost 10%. We're talking about the longest winning streak in about a year, although in the after session, it's a little bit of pressure, down 0.3%. Of course, this is the second consecutive drop in quarterly deliveries for Tesla, but that wasn't as steep as analysts were predicting. So we're talking about 25% gains in the past 6 days, and Tesla adding more than $145 billion to its market cap. Let's get more insight with Michael Dunne, CEO at Dunne Insights. Michael, great to have you with us. The market reaction to these numbers, although a drop less than expected, is this sort of confidence on Elon Musk's vision about Tesla? Because he seems to be veering more towards artificial intelligence and technology advances at this point.
That's exactly right. One of the things that makes it so hard for other automakers to compete with Tesla and with Elon Musk is that he moves so fast. He's never standing still. And here again, whereas most of the industry is saying, boy, it'd be great to catch up with Tesla in sales, he's already moved to the next phase, and that is Tesla is now an AI and robotics company. And on August 8th, he promises to unveil the very first Tesla robotaxi. So the market saw this and said the shares surged today, in large part as a vote of confidence in Elon Musk, and secondarily in the sales performance for this quarter.
But looking at the deliveries itself and just how the car maker itself is doing, we have seen, of course, Tesla go through a tumultuous year, whether it's a slow pace of deliveries when it comes to the Cybertruck as well. Can we say that the worst is over for Tesla, or could we see more challenges to come?
One of the things that Elon said in recent months is that without autonomous driving, Tesla as a car company is worth not very much at all. He sees the Chinese automakers in hot pursuit, and he understands that to really differentiate his company going forward, it won't be about the number of cars he sells or Tesla sells, but rather the value that is brought forth with robotaxis and autonomous driving. That's the extreme goal he's pursuing, and he's out in front of everyone else. Now, what we don't know as investors or as observers is how soon he'll get there. He definitely has a tendency to promise things and then deliver late, but he almost always delivers. And this is one of the reasons why shares are up so strongly today.
What do you make of the robotaxi competition coming from China? Because we've seen, for instance, the likes of Baidu already rolling out these vehicles in cities like Wuhan. Do you see that competition from China in the EV space also transferring across to robotaxis and autonomous driving as well?
Absolutely. And if anything, we are going to see robotaxis and autonomous driving take off first in China, in no small part because regulators in China want to see commercial success of autonomous vehicles in their country, in their market, at home first. And it wasn't a coincidence. Just a few weeks ago, Elon Musk was in Shanghai to meet with Li Qiang and get his blessing so that Tesla too could compete in the robotaxi and autonomous driving market inside China. That's where the action will be first, and it'll happen much more slowly in the United States and Europe, where regulators are uber wary of accidents that might be related to autonomous. So the game for autonomy is in China. That's why Elon wants to roll out his own FSD there soon.
On the flip side, though, of course, there's that concentration risk because Tesla is so heavily concentrated in China, particularly for production. There's the rising risk of tariffs from Europe, the US, other places. How quickly do you think it can diversify its production bases?
That's a very delicate dance because Elon wants to stay in China's good graces. But behind the scenes, you can bet that Elon and his team are moving as fast as possible to find new production bases, expand in Austin, expand in Berlin, perhaps add India, because today, 1 of every 2 Teslas built globally is built inside China. That's considerable risk. Elon understands it and wants to move to diversification as quickly as possible without upsetting, of course, the powers that be in Beijing.
Given those tariff risks, we have seen some interesting overseas strategies coming from various Chinese EV makers, including Leap Motor, which has teamed up with Stellantis, for example. Are we going to see more of such examples going forward? And what are the risks for those partners on the other side, for example, for Stellantis itself?
Yes, you guys may have seen just a few weeks ago, I penned an op-ed that said when every single car is made in China. So here's the scary part. Not only are Chinese automakers extremely competitive, Chinese brands inside China, but now we're seeing global automakers, including the likes of Stellantis, Ford, GM, Toyota, even Honda, making China a production base for exports to markets globally. If this trend continues, it wouldn't be long before China's building half of total demand for cars worldwide. The risk is that jobs, industries in our home countries, the United States, Germany, France, Japan even, start to melt away as this juggernaut called China just overwhelms markets because it's lower cost, higher quality, and more efficient. That's where we are, and it has boardrooms worldwide really nervous about the potential for this outcome from China.
Beyond the focus for Tesla on robotaxis, there's of course the concerns around its aging lineup or the aging look of some of its fleet. Elon is promising more models to come to market, but where do you think those innovations are likely to be most? Are we expecting more vehicles, or what do you see ahead there?
Kind of counterintuitively, I think it'll be fewer vehicles and more options when it comes to software and autonomous driving. So we've seen already one of the magic superpowers of Tesla is that they've been able to accumulate huge volumes with just a handful of cars. The Model Y was the single best-selling car worldwide last year. So look for that to continue. Not a flurry of new products, but rather an enhancement of current products through autonomy, through software. That's the differentiator of the future. And that's where Tesla still enjoys a significant advantage. When I talk to Chinese automakers, I ask them, which global automakers do you fear the most? All of them say the same company, that's Tesla. And there isn't an easy second place, like maybe Toyota, maybe Volkswagen, maybe Mercedes, but Tesla's at the top.
That was Michael Dunne there, CEO at Dunne Insights. And as we said, Tesla, one of the big gainers intraday on Wall Street, surging more than 10% on the back of those delivery numbers. But let's take a look at how markets are faring so far in the session. US futures and are looking a little steady here, but still the context, of course, we saw the S&P 500 closing above 5,500 for the first time ever. I think it's the 32nd record that we've seen for US stocks so far this year. So you are getting that optimism that's so far translating to Asian futures. You've seen the likes of the Nikkei, the ASX 200 looking for some gains here. Of course, as well, trading around the expectations not only of earnings that are coming up, but there's also positivity around the outlook for inflation and the outlook for the Fed. And the focus really on that Sintra Forum in Portugal. And we heard there from the Chicago Fed president, Austin Goolsbee, who says policymakers should cut interest rates if the US inflation continues to fall back to the bank's 2% target. As I said, Goolsbee speaking to Bloomberg in Sintra, Portugal.
Look, there's a danger from waiting, and there's a danger from making wrong moves. The basic function of the central bank and what the Fed's got to decide is we move to a quite restrictive posture. We raise the rates a great deal in a short period of time, and we've been holding it there. We got to this rate when inflation was over 4%, and inflation's now down close to 2.5%. So if you sit with the rate somewhere while inflation goes down, you're tightening. And the reason that you would want to tighten is if you think you're not on path to 2%. If you're on path to 2%, you've got to take seriously that the U.S. central bank's got a dual mandate. So if employment starts falling apart or the economy begins to weaken, which you've seen some warning signs, you got to balance that off with how much progress you're making on the price front.
So how worried are you about the unemployment rate, but with the jobs slowing down? I mean,
the unemployment rate is still quite low, but it has been rising. And if you look at quit rates, if you look at the ratio of vacancies to the number of unemployed workers and various conventional measures of the job market, they're cooling, but they're at a level which is still pretty strong. That's kind of what we've been trying to fully sort out. Now, I think if you look at the second half of last year, in the U.S., we had 7 straight months of excellent inflation. We hit a bump in the road in January of this year, but now we've gotten a string of improved inflation readings. If we get more like what we have just seen, to me, that feels like the path to 2%.
Chicago Fed President Austin Goolsbee speaking with our colleague Francine Lacroix. We have more ahead on the Asia trade. This is Bloomberg. We're watching the impact of wild weather on commodities markets. European natural gas prices steadying as traders weigh the effect of heat waves and potential weather-related supply disruptions. We're also watching oil prices as the Atlantic hurricane season gets underway. Asian LNG also at a high point for the year on higher demand outlook. China, meantime, is accelerating new investment for LNG importing terminals. Supply is on its way, though. Bloomberg NEF's latest outlook sees a record number of projects coming online in the next few years. The black market may even add more supply, with Russia suspected of building a shadow fleet for gas. Let's bring in Bloomberg NEF's head of APAC Gas and Global LNG Research, Abhishek Rohatgi, and our senior energy reporter, Stephen Stepchinsky. Abhishek, let me start with you because you had that outlook report talking about potentially more supply coming up. How much more are we thinking of in the next coming years?
Thanks for the question. So our estimates for LNG supply exceed the demand projections from 2027 onwards, and this is resulting in an increasingly oversupplied market by the end of this decade. Overall, we are expecting supply from operational, under construction, and expected projects to reach roughly 623 million tons in 2030, and most of this supply increase is driven by the projects in the US and Qatar. Then demand, on the other hand, is only able to reach 560 million tons by 2030, which is roughly 10% lower than supply. However, we think that these incoming excess supply levels have been softened due to project delays seen across the various supply markets, and sanctions on Russia are also constraining supply. Russia is assumed to have lowered its output from 2024 onwards in our projections as compared to a no-sanction scenario, and buyers may also hesitate to renew their Russian contracts expiring at the end of the decade, and this has further weakened the oversupply levels in our coming years.
So, Abhishek, a couple of risks there, but as you say in your report, gas is looking to be possibly the last fossil fuel standing. What are the key factors driving the demand here, and as well, where are the key markets for that?
So there are 3 key factors we think that are driving the LNG demand growth up to 2030, and these include decarbonization, infrastructure expansion, and lack of enough domestic gas supplies. Efforts to lower emissions are prompting various demand markets to move away from coal and leading to higher demand for gas in the industry and power sectors. In our forecast, China is said to be the biggest LNG growth market, with increase happening across all the consumption sectors. And then in the emerging Asian markets of South Asia, Southeast Asia, we think India and Thailand will be leaders in raising the LNG imports. In India, infrastructure expansion is the key driver for demand increase in the city gas and industry sector. And in Thailand, we have lower domestic supply, which is supporting more LNG imports. For Europe, we are also expecting gas demand to increase over the next 2 years because of lower coal generation. However, Europe is said to see a structural demand decrease in power after 2 years because of the growth in the renewable generation sources.
Stephen, I want to bring you in here because we just heard there that the fate or the outlook for Russian gas is a little bit in limbo with sanctions on the horizon, but your reporting says that there could be even more supply coming from Russia through this so-called shadow fleet.
Yes, certainly. Now, Russia's big plan for the last few years has to boost the amount of liquefied natural gas on ships into the market. because they lost Europe as the biggest customer of pipeline gas after the war in Ukraine began in 2022. Now, that has been challenging. The expansion of their LNG exports is primarily through a project called Arctic LNG 2. And the U.S. actually sanctioned it last year. Partners, including Total in France, Mitsui in Japan, have called force majeure on the facility because the ships can't come and pick it up. Actually, there are no ships available to pick it up because of the sanctions and other rules against the facility. So Russia is starting in the very early stage to do what they did with oil, which is to create what it appears to be a fleet of ships that could be described as sort of shadow in appearance, in the sense that they're connected to companies no one's ever heard of, and they could be doing something that could get them in trouble. But if they're going from point to point, let's say Russia to China, then it doesn't really matter. Now, it's going to be hard. Russia exports about 30 to 40 million tons per year of LNG. They want to get to 100 million tons per year by 2030. But if their facilities keep getting sanctioned, that's really difficult. What's interesting is, instead, as Abhishek mentioned, instead of Russia LNG expanding over the next decade, instead Qatar or the U.S. could take that spot and kind of not force them out of the market, but take customers that would have otherwise gone to Russia are now going to the U.S. and Qatar.
So, Stephen, I guess long term, the question is, if you have demand and supply booming for LNG, where does that put the energy transition?
Well, it makes the energy transition difficult if LNG is too affordable to switch to renewables. I mean, I think when you look at the energy transition, we're at Bloomberg, right? This is all about money. It's all about capitalism. It's all about price and price signals. So if renewables are the right choice, if it's cheaper to turn to renewables, wind, solar, batteries, maybe in the future, hydrogen, or even nuclear, then that will clearly help with the energy transition. You'll be able to get those zero carbon facilities online. But if this rush of LNG, if there's this really big glut, then emerging nations will increasingly turn to natural gas because it's affordable and cheap. So there is a risk if there is too much LNG, if the LNG market is flooded, then that could make it challenging to transition to cleaner sources faster. It's all a really fascinating story. Clearly, gas is part of that story. It's a bridge because when combusted, it produces half the amount of CO2 than coal from power plants. But still, there are tricky issues like methane emissions, which are we're now just trying to figure out how much methane emissions are affecting the total gas, pollution, greenhouse gas profile of LNG. So all that together is to say the more gas that comes into the market, it will be potentially challenging to quickly transition to zero emission generation.
Abhishek, when it comes to Asian buyers, how dependent are we expecting them to be to the spot LNG market in the coming years?
So globally, we are estimating that roughly 77% of the total LNG demand in last year was contracted under long-term destination-specific contracts. And we think that this is going to fall to only 61% by 2030. So most of this increase in uncontracted demand is coming from Asia, where demand growth will drastically outpace the new contract signed. Markets like South Korea, Taiwan, India, and Thailand are driving this increase. And these numbers suggest that Asian buyers may be looking to increase their spot share in the coming years with the hope of decline in spot prices. However, we think that spot prices will continue to stay volatile as there is a huge risk of supply project delays and sanctions, and hence buyers may want to balance these long-term and the spot volumes.
That was our BNEF head of APAC Gas and Global LNG Research, Abhishek Rahatchi, and our senior energy reporter, Stephen Sapczynski there. We'll have more ahead on the Asia trade. This is Bloomberg. The latest stories on the corporate front that we're tracking this morning, and sources say independent film and TV producer Skydance Media has reached a preliminary agreement to buy Shery Redstone's National Amusements and merge with Paramount Global. The Redstone family controls 77% of Paramount's voting stock through National Amusements. Sources say an agreement could be announced within days, though the deal could still fall apart. The accord followed the collapse of talks last month. Bloomberg has learned that Apple is getting an observer role on OpenAI's board. Sources say Apple's App Store head and former marketing chief Phil Schiller has been chosen for the position. They say the agreement will take effect later this year, and Apple earlier announced it would offer ChatGPT in the iPhone, iPad and Mac as part of its suite of AI features. Bloomberg has learned Anglo American is weighing options to push ahead with the sale of its coal business after an explosion in its flagship Australian mine. Sources say this may include selling individual assets or excluding the damaged operation in a possible deal. The plan to exit coal was part of a dramatic restructuring announced early this year as Anglo fended off a takeover pursuit from BHP. Eli Lilly has won US regulatory approval for its Alzheimer's treatment, which has faced a number of regulatory delays. The drug, called Kisunla, will compete with Eisai's Alzheimer's treatment, which has been available in the US since early 2023. Lilly says the drug will cost $32,000 in the first year of treatment. Both drugs remove certain toxins from the brain and are only approved for early-stage Alzheimer's, Shery.
Well, we're setting up for the market opens across Asia. Of course, we have the Nikkei at the highest level since March, the Topix at the highest level since in 34 years. We'll see, get some follow-through from the U.S. session because Wall Street just finished at another record high. What is it? The 32nd one for the S&P 500 this year. Financials, consumer discretionary leading those gains, although the future session is seeing a little bit of pressure. Of course, we had the standout Tesla shares jumping in the New York session, the longest winning streak in about a year, and adding about $145 billion to its market cap in the past 6 days. We had a second consecutive drop in quarterly deliveries, but that drop wasn't as steep as analysts had expected. So you can see right now a little bit of pressure, but on the Wall Street session, we actually had those big gains, especially after Chair Powell cited signals that the U.S. is back on a disinflationary path. Will we see that follow through in the Asian session with the Japanese yen holding at around that 1986 low is the question we'll bring you. The market opens in Tokyo, Sydney and Seoul next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. After another record high on Wall Street, investors digesting Chair Powell's comments that we are seeing quite a bit of progress in reducing inflation. Does that mean that we could see a rate cut very soon? Of course, is a key question, Belle.
Yeah, absolutely. Traders are really pricing that in now. Also looking at the prospects for a second term for Donald Trump. But we did just see that 32nd record for the S&P 500 overnight. The question, of course, is how that translates into Asian trading today.
Especially as we saw the volatility in the Treasury space, right? We had yields falling after Chair Powell's comments, but at the same time, given that we saw that rise in job openings, that fall was buffeted a little bit. JGB yields in Japan have held above that 1% level on expectations that the BOJ will actually have to hike rates in July, given, of course, the weakness of the Japanese yen, which is still holding at that 1986 low. Will we see a little bit more strength in today's session is the question, given, of course, that we have seen a little bit of dollar weakness after 6 weeks of gains, given the moves in the Treasury space as well. But take a look at the Nikkei right now, gaining 0.3%, while the Topix is also holding at that 34-year high. So we continue to see the optimism when it comes to the stock space across Japan. But take a look at what Korea is doing, because we had the Korean won also being under pressure because of expectations that the BOK will actually have room to cut rates. We saw inflation decelerating in the month of June, still above that 2% target, but you're seeing the Korean won, perhaps a little bit of strength against the US dollar, which of course weakened overnight, and the tech-heavy Kosdaq as well up 0.4%, Belle.
Yeah, Shery, and also just taking a look at how Aussie stocks are coming online this morning. You're seeing fairly flat, of course. It's a staggered start, so we'll just wait a few more moments here. But broadly in the Asian session or Australian session today, there's the focus on Wall Street, of course. That's going to give us a tailwind. What could be a headwind, though, is the economic data, because you've got retail sales numbers that are due in the next hour. Could tell us that the environment is looking really challenging. Building approvals numbers, they're due as well. So some of the eco points that we're watching out for, as after we had that PMI data, private reading, of course, from Judo Bank, but telling us that the composite reading moved lower from the month prior, so coming in at 50.7. It was 52.1 in the prior month. What else we're tracking, as we said, those moves that we had in the bond space. We saw yields falling on Wall Street. Again, you're just seeing a slight pullback this morning. It is that expectation around Fed rate cuts. And as we said, Shery, really that focus on what Jay Powell said, and this signaling that we're getting that we're back on a disinflationary path, at least in the US.
Yeah, and the reaction that we saw in the U.S. stock market, right? We talked about that 32nd record high already, and the S&P 500 closing above the 5,500 level for the first time ever. Our next guest says markets are more evenly balanced compared to the start of the year. With us now is Ed Gomes, CIO at SGMC Capital. Ed, great to have you with us. When you say the markets are more balanced, is this in terms of the tone where everybody finally seems to be bullish about the markets? Because when it comes to those gains and returns that we've seen, it's been really lopsided towards the Magnificent Seven.
So when we're talking about more balanced, it's more from the perspective of views going forward, and also from a valuation perspective. So you started the year when a lot of analysts were somewhat skeptical, somewhat pessimistic about the year going forward. But as the rally has gained steam, you've seen leading bears capitulate, famously Mike Wilson from Morgan Stanley, and now cheering the market higher. When you have situations like this after significant rallies, you will see people trying to hype up stuff more and stocks more than what they're otherwise worth. We've been bullish on markets over the last 18 months, had a good run with this. And by no stretch of the imagination are we turning bearish. It's just recognizing the fact that everyone's talking about equity, everyone wants to get in. NVIDIA is the market darling. Now we'll find new ones to take NVIDIA's place probably. And in that sense, markets are more balanced.
Does that mean that you're also reducing some of your exposure in U.S. equities?
Over a period of time, we've stopped buying. So we're moving more to a hold strategy rather than actively allocating. We'd be very comfortable buying into any kind of declines. And we could see declines based on election surprises, based on geopolitical volatility, based on just a flare-up in the VIX, which tends to happen now and then. So we'd use opportunities into declines to build back exposure. But at this point of time, we don't particularly want to keep being in the bullish camp after a fairly good run over the last 18 months.
Where do you think the bumps in the road could come from, Ed? We've got elections coming up. Do you see that as injecting a level of volatility? I mean, if you take a look at the VIX, for instance, we've been sitting around 12 for much of the year.
Absolutely. So the elections, and you're still talking about at least 3.5 to 4 months before we even get to the event. There is a fair amount of speculation in terms of Biden's ability to run again. Trump in the prediction markets is already factored in with like a 70-odd% probability of coming in as the new president. But all of these things, do tend to produce surprises. Lots of machinations happening behind the scenes in terms of how this will progress. So we just need to wait and see. But yes, the U.S. elections will be one of the big areas that we keep an eye on.
And with those elections in mind, of course, it's that focus on tariffs, particularly the US-China trading relationship. Is that a reason for you to be more cautious on mainland markets, or do you see opportunities here just given the valuations being so cheap?
With China, we're looking at tactical allocations to the markets. We still don't think we've seen all the regulatory pressures being digested. On balance, you see new regulatory changes being pronounced now and then. And as a function of that, it's actually hard with the underlying playing field moving around so much. It's actually hard to take longer-term views. So we view China as being good value, but at the same time, until the regulatory pressures ease, we're going to take it and look at it as a very tactical play. If the market declines for a week or two, we're happy to buy, make a quick return and lighten up positions again. It's not a core hold as we did have in the past.
And the caution includes some of those Chinese tech names, because we have seen, of course, a regulatory concern sort of dissipating on that side after the clampdown that we saw in the past couple of years, and the boost coming from all the AI frenzy.
Absolutely. So AI is going to be a theme, right across. But when we're playing the AI and the tech theme, we'd rather look at the U.S. They're clearly leaders in the space, and the opportunity set, is a lot larger and a lot clearer for us, as longer-term investors. So whatever we're looking at from the tech space and the AI space, we'd rather focus on the U.S. We do have some allocation to China, but not as large as the U.S.
What about here in Japan? We have seen really a lot of optimism about the Japanese equity markets, but finally there seems to be a little bit of caution when it comes to this continuing depreciation of the Japanese yen.
Well, the Bank of Japan, has painted itself into the corner. They've talked about the fact that, they had some kind of expectation that the yen should not breach 152, I think was the level that they were looking at. A lot of verbal signals, very strong verbal signals as we were getting to 152. But when it broke, they've gone silent. Now we're seeing some kind of statements come out, but not at the same frequency. And there's been no action that they've taken. So, you've had some kind of intervention, but, to stem the kind of flows that you're seeing with the rate differentials, meaning Powell's not even talking about, Powell's not even done his first cut, and Bank of Japan's hiking by like 10 basis points. So the interest rate differentials are just too juicy to ignore, and that's what global traders are focused on.
Yeah, that rate differential is certainly the focus. How does that play in then to your outlook for the dollar over the course of the rest of the year, and in turn Asian FX and broader equities?
So we tend to be partial to the U.S. dollar, barring, even aside from the rate argument. There's still good growth despite the fact that rates are as high as they are. So multiple sectors are kicking off. You also have a theme which is gaining traction in the U.S., which is reindustrialize. So they want to bring back jobs. They want to bring back manufacturing, to the shores of the United States. Over a period of time, and that in itself will be not just tech jobs, but jobs in all kinds of industries and manufacturing. So with the strength of that movement and the strength of the overall economy, the U.S. dollar is and the U.S. economy, I should say, is going to keep powering ahead. That has implications for the dollar. You will have points in time when the dollar does get extended and it does lose. But we're not seeing that level of strength in most other economies, not even in China. So to that extent, we're very comfortable with long dollar positions. Global equities, we think that global equities will take their cue from the U.S. markets. So while we are, moving to a slightly less bullish stance in the U.S. markets, I think global markets in general will be fine, barring, of course, any kind of geopolitical conflict, which keeps flaring up.
Yeah, of course, we'll continue to watch all of the tensions around the world. Ed Gomes, CIO at SGMC Capital, joining us with his calls on the markets as we continue to watch some of the early trading action with Tesla suppliers. A little bit of a mixed picture after Tesla jumped in the New York session. We're seeing a little bit of pressure in the after-hours session, but we're talking about the longest winning streak in about a year for the EV maker. The second consecutive drop in quarterly deliveries wasn't as bad as analysts were predicting, so the market reaction was very positive in the New York session. We're talking about gains of more than $145 billion in the past 6 days. We have more ahead on the Asia Trade. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg has learned China is making and testing lethal attack drones for Russia. That's according to European officials familiar with the matter. Our China correspondent Min Min Lo joins us in Hong Kong. And Min Min, China has continually sought to portray itself as being neutral in this conflict, but this latest reporting, or what we're hearing from sources, suggests anything but, really.
Yeah, so European officials speaking on condition of anonymity is saying that Chinese companies are now in talks with Russian companies to develop a drone that is modeled after Iran's Shahed drone. Now, that's a sort of kamikaze drone that is not meant to survive its attack. It can loiter for hours to look for its target and then just launch a strike. It's very cheap to make but hard to defend against. And Russia has used thousands of these drones since the start of the war. And the worry is that China will now be able to produce it at a much faster pace than Iran can. And these European officials are saying that, there are concerns that this would really cross their line of providing lethal weapons for Russia. Now, obviously, China has repeatedly said that it doesn't provide weapons to any party of the war. Instead, it has made veiled swipes at other countries that provide weapons to Ukraine directly. A U.S. official has backed up those claims, saying China does not provide weapons directly, but China has provided components, ball bearings, machine tools, and these dual-use equipment to Russia. But China says that it has been controlling the export of those equipment. So if this is true, it will likely really trigger quite a forceful response from the West, perhaps more sanctions on China. So something to watch.
Yeah, as you say, it would really be quite a dramatic escalation. But Beijing, if it is indeed playing a big role, also can really shape the conflict. And then we've been hearing as well from European officials who say that they could end the war with perhaps even just a phone call.
Yeah, so there's a lot of talk, especially from that Finland president, saying that China and Russia relations are really so close now, and Russia being so dependent on China, that gives China a lot of leverage to end the war if it so chooses to. And there is a lot of frustration that China is still helping Russia to circumvent these sanctions from the West. It is buying Russian gas and selling it cars and equipment. And if you take a look at the table, China's trade with Russia has dramatically increased over the last few years, and the opposite is true for the European Union. It's nearly half, more than half, in fact, over the last few years. So have a listen to what the Finland president had said in the context of this war.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
And the Finnish president is now saying that Europe should really shift to a wartime economy. And he says the European Investment Bank needs to shift its red line to start financing some of those military industry in Europe. And this comes, of course, as Finland shares that thousands of kilometers long border with Russia and really guarding more than half of NATO's demarcation of border against Russia.
Yeah, that China-Russia relationship really tight for decades. We know that they established the Shanghai Cooperation Organization as well more than 2 decades ago. They're holding a summit. What can we expect from that meeting?
Yes, so President Xi just landed in Kazakhstan and he is going to meet with President Putin again, their second meeting in 2 months after Putin had visited Beijing just in May, when the two sides hailed their relations and pledged to deepen cooperation on economics, geopolitics and military ties as well. One big announcement we're expecting from the SCO summit is that Belarus is expected to be included as a new member. Now, this would bring the total membership to 10 after Iran also joined last year and India, Pakistan as well joined in 2017. Now, President Xi likely to hail this growing membership as the growing relevance of SCO in the world, really part of his campaign to try to push towards this multipolar world. Economy is going to be on the agenda because China's Belt and Road Initiative has found many partners among the Central Asian countries. They're also going to discuss anti-terrorism issues given recent developments in Pakistan and Russia as well, and geopolitics are going to be on the table as well, that war in Ukraine in focus, especially given the recent accusations that China is developing those new drones for Russia.
Our China correspondent Min Min Lo there with the latest on geopolitics. And these are some of the other stories that we're following today. The sentencing for Donald Trump's New York hush money case has been delayed by 2 months to September 18th. This is so judges can review the impact of a landmark U.S. Supreme Court ruling about presidential immunity. The sentencing would come less than 7 weeks before the likely Republican nominee's rematch against President Biden. Trump faces up to 4 years in prison for the criminal case. About 116 people were killed in a stampede at an overcrowded religious event in the northern Indian state of Uttar Pradesh on Tuesday. It's one of the deadliest such incidents in decades. The death toll includes mostly women as well as 7 children and a man. The stampede took place after the crowd rushed toward the preacher to seek blessings. We have more ahead on the Asia trade. This is Bloomberg.
I think that a technocratic government is not in the French tradition at all. It might be a solution in other countries, namely Italy. What I would expect in case there is no absolute majority by either political sensitivity, I think that the president would probably try to have a coalition government.
There are elections all the time. There have been movements in spreads all the time. Of course, France is a very important country, but this looks like an orderly repricing to me.
That was ECB Chief Economist Philip Lane and former ECB President Jean-Claude Trichet on the French elections, as we are now seeing European futures coming online in the Asian session after the European benchmark took a hit in the overnight session. We had healthcare leading the declines, but right now we're seeing upside when it comes to the Euro Stoxx 50 futures. And of course, all eyes were on French debt because we are now seeing the highest risk premium for French sovereign bonds since 2017. Of course, this is due to the snap election that we're seeing in France. We are headed towards the final round on Sunday as well, at a time when we have seen the broader economic recovery around Europe perhaps taking hold, Eurozone inflation slowing towards the ECB target. Still, President Christine Lagarde has talked about more uncertainties to come, so we'll be watching that closely, Belle.
Yeah, that's right. Lagarde certainly playing for time on rates, and that call for patience is also being shared by Jay Powell as well from the Fed. But we heard from the Roubini Macro Associate CEO, Nouriel Roubini, and he says the US is actually headed for a soft landing. He spoke to us exclusively, also talking about the Fed and why it is right to wait before cutting rates.
I would say they overall are doing it right. On one side, they're still worried that the surge in inflation occurred in the first quarter may be slightly more than temporary, even if the latest number suggests a softening of core PCE. But now there's also something of a slowdown of the economy, something of a softening of the labor market. There is job creation, but the unemployment rate has ticked up towards 4%. So there is better balance and there is a slowdown in the economy. So based on their dual mandate, they have to worry about the inflation, they have to worry about growth as well. So I think they're right in waiting until they start cutting rates.
Nouriel, do you think that the risk should be more on the inflation side or the growth side, in that the risk is higher inflation or lower growth? Which camp would you be on?
Well, until recently, I would have argued that the biggest risk was upside on the inflation side, but now economic growth has slightly moderated, consumption is slowing down, there is some slackening in the labor market. So I think that the Fed wants to achieve a soft landing, but not a softish landing. They don't want to go to 2% with even a short and shallow recession, and therefore they have to start thinking also about the downside risk to economic growth.
Are we out of the woods yet in terms of we can avoid a recession, at most we'll get a soft landing?
Yes, with one caveat. You know, a year ago, everybody worried about a real hard landing. Then there was a risk of a softish landing. Then people said, no, we're going to achieve a soft landing. But recently, there was both a growth above potential and inflation above target. So the risk was that actually the economy was growing too fast and will be in a no landing situation. And no landing will lead the Fed to stay high for longer or even higher for longer. That was the risk. While I would say that right now the softening on the growth and labor market side suggests that maybe the risk of a no landing is reduced and we're going towards maybe something closer to the goal of the Fed, that is a soft landing.
Roubini Macro Associate CEO Nouriel Roubini speaking exclusively with Bloomberg's Alex Steele and Scarlett Fu there. Take a look at how the Topix is trading at the moment. Really not doing much after touching that 34-year high earlier this week. We're talking about tech and materials leading the gains, but we do have energy stocks and financials weighing on the index. Of course, we have seen incredible optimism when it comes to equity markets across Japan. The Nikkei is also at the highest since March. We have seen gains for the Topix and the Nikkei, double digits in the first half. We'll continue to watch if this can actually last, given that the Topix 14-day relative strength index is now nearing that overbought territory at that 70 level. We have more ahead on the Asia trade. This is Bloomberg.
I think the last reading and the one before it in inflation and the one before it to a lesser extent do suggest that we are getting back on a disinflationary path.
Chair Jerome Powell there, of course, some of his comments really took markets to gain ground in the overnight session on Wall Street and see another record high for the S&P 500, surpassing that 5,500 level for the first time. And some of that optimism about potential rate cuts coming really being follow through in the Asian session, where we have the Nikkei now at the highest level since March. The topics continuing to hold around the highest level in 34 years, and the Kospi also rebounding from those losses that we saw in the previous session. As we're getting also the PMI numbers for Singapore for the month of June, we're getting it at 55.2, which is an improvement from the previous month at that 54 level. We're also getting the final numbers for the Jibun Bank Japan PMI composite number into contraction territory. Is being revised down for the final number in the month of June. The expectation was for it to hold at that 50 threshold level, but the composite is now back in negative territory for the first time in 8 months, while the services number continues to be in contraction territory at 49.4 for the month of June, Belle.
Yeah, Shery, and let's also shift to take a look at what's happening in the bond space as well, because we saw moves, of course, in treasuries, but the other theme or area we're really tracking is what happens in China's bond space, and here it's, of course, a very different story. On Monday, we had the impact of the PBOC move, so what we understand is that they could be looking to borrow government bonds from primary dealers. This is a sign, of course, that they could be contemplating selling securities, so it's trying to just cool down that very hot bond market. We've seen the reaction in yields, and we've just seen them, of course, coming off that record low. But the question is really, how long does this last for? Let's get more with Jenny Zhang. She's APAC Fixed Income CIO at Allianz Global Investors. And Jenny, exactly that. How long do you think this lasts for?
It's very interesting what happened on Monday, in fact, because PBOC announced that they may come to borrow CGBs from the primary dealers. In fact, if you think about it, this is not the first time that PBOC is trying to send a message that the yield is a bit too low, particularly on the longer end, right? If you remember back in April, that's when when we hit that level on 10-year and 30-year, PBOC came to the market, in fact, said, okay, we may start to trade securities, the government bond. That's April. And then after that, bond market spiked 10 basis points. But of course, it came all the way back to where we saw on Monday morning. Now, I do think this is an even stronger, more powerful message from PBOC now that they say, okay, we may actually borrow from the primary dealers, and then we may sell it when necessary. So again, this is a message to say we don't want the yield to be so low. Then if you think, okay, why is that the case? What's PBOC's main concern? We think that the main concern here is financial risk. That's a lesson learned from the SVB incident back in 2023 in the U.S.
But there's also the question of what is the low yield expressing in it, and its concerns around the health of China's economy. It's the outlook as well, or the need possibly for some further easing. But what do you think then happens to yields over the shorter term? Are we setting up for some sort of trading range now?
You're absolutely right. Also the perception of the economy. Sometimes interest rate is also reflects a perception of the economy. So on the other hand of the equation, PBOC might not be willing to send a message that too low yield reflects, a weaker economy, right? They don't want to see that. But again, we need to focus relatively more longer term. Where are we in the economic cycle? We have been arguing that the Chinese bond market is in a structural bull market from probably end of last year. The reason being we see China going into a very different economic cycle versus the past 2 decades, right? That's not going to change. Now, if we're going back to fundamentals, and the most recent data released by China suggests that there remains challenges in the economy, and economic growth is unexciting, let's put it that way. We still need the monetary policy to be overall accommodative to what China wants to achieve for this year.
How do you want to then set up for positioning? Do you want to be defensive then going ahead?
We do think near term, let's see how market receive this time, because last time it was just literally a blip in terms of how yield went up. So we really think that there's limitations on how high yield can go given the economic situation right now. But we prefer currently to play a steepener, because in fact, if you look at the 3 and the 10s curve, it has been quite steep. So that's what we prefer to do in the CGB at the moment.
So given that the PBOC is now signaling borrowing directly from primary dealers, you have mentioned, of course, this is sort of a warning to the global bond rally. But at the same time, how much is this a setup for better liquidity management in the financial system? Because we had also those indications coming from the PBOC governor in his Shanghai speech that we might see the biggest rewiring of that whole monetary system in decades.
You're absolutely right. That's an extremely important point, because last month in the PBOC governor's speech, he sent two extremely important messages. Number one is he still sees room to ease monetary policy in the medium term. And the number two is there will be a shift of focus from quantity to price, so i.e. to interest rate. I think that's going to change the overall mentality of monetary policy in China. But this is also reinforce our view that if we can look beyond the very near term of the rates volatilities due to technical reasons, we still believe that there is room for China yields to continue to go down.
Jenny, have authorities done better when it comes to taming volatility in the yuan currency space?
Yes, absolutely. And this is also why we continue to like CGB in the global bond portfolio. Because if you look at the CGB, the correlation with other bond market actually has still been very, very low. And the PBOC has done a great job of maintaining that FX stability. Right? So we expect that both to continue.
What does that mean eventually when it comes to the Chinese economic recovery and that 5% growth target?
We're actually reasonably constructive and confident that China can achieve that 5% target this year. The only drag in the economy, or the key drag in the economy, remains construction activities because of the property cycle. Now, we started to see some signs of property, stabilization, I would rather say, but we think that, towards probably the second half of next year, we can see construction activity normalizing into that. So, but export has been doing really, really well, and we will see more and more fiscal policy taking place in the second half of the year. We also expect the government to issue even more special government to support that infrastructure spending. So overall, we're not too worried about achieving that 5% target. What's more important here is the quality of that growth, and also whether China can buy time for them to really go through that restructuring of that economy to get a better quality of growth going forward.
Yeah, and of course we might get more insights into that at the third plenum coming up later this month. But that was Jenny Zhang there, APAC Fixed Income CIO at Allianz Global Investors. Thanks so much for joining us this morning. We'll have more ahead on the Asia trade. This is Bloomberg. Sources say a growing number of top bankers at China's premier investment bank, CICC, are pledging their loyalty to the Chinese Communist Party. That's the focus of today's Big Take, and our senior editor for Greater China Finance, Jonas Bergman, joins us now. And Jonas, it's a really fascinating story because we know that President Xi has really been focused on remodeling the financial landscape inside China. But what makes it even more pointed is that CICC was once likened to the Morgan Stanley of China. So what exactly is going on right now?
Yeah, exactly. As my colleague Kathy Chan reports today, there's been quite a big transformation and was basically the poster child of China's financial ambitions over the past 3 decades. What we're seeing is obviously pay has gone down quite a bit across the financial landscape, and especially and also at CICC. Bonuses are basically zero. Pay is cut by 25%. But more fascinating is that we're seeing that Communist Party membership within CICC is close to 1/3 or 30% of the top bankers, which just shows you a sign of the broader transformation that's going on within the financial landscape in China.
And do you think now that having party membership is really seen as the best way to get ahead, especially if you can't get that bonus?
Well, that's what we're hearing. And what once was, an industry or a company driven by, who were the best deal makers, who brought in the biggest clients, it's now seen as one of the best ways to get ahead within the bank of having that party membership. At the same time, we're hearing from people that morale is very low at the bank, that productivity per banker is down. There's obviously a very tough landscape as well that they're facing in terms of deal making, both internationally and domestically, even though we're seeing a bit of a pickup right now.
Jonah, so when greed is no longer good in China, not even a little bit, then what really does this mean for the broader financial industry in the country?
Well, that's certainly will play out in the time to come. But more broadly, in the financial industry, it's being redrawn into a more of a industry that will work for the benefit of the party, and also for the benefit of the broader economy as they see it. So we've seen obviously a huge crackdown on corruption as well within the financial industry, with over 100 top executives being detained or cited. We're seeing a slew of graduates, for example, from Chinese universities who used to be able to go to the finance industry for great jobs, are no longer seeking those out. This is not sort of only related to the finance industry, of course. There's been a broader crackdown on private business and the private enterprise. But obviously they want less capital to go to the finance industry. Whether that's good or bad for the Chinese economy and for China as a whole, that remains to be seen.
Yeah, and Jonas, as we say in the piece, CICC is really fighting for its future here. Well, it's a really fascinating big take, and that was our senior editor for Greater China Finance, Jonas Bergman, there as well. You can read that story in full on the terminal on Bloomberg.com, and also you can hear about it on the Big Take Asia podcast. You can listen to that on iHeartRadio, Apple Podcasts and Spotify. New episodes of the podcast are dropping every Wednesday. It's not just about hedonistic lifestyles that we're seeing being pushed back at Chinese lenders. Bloomberg has learned that HSBC as well is slowing down hiring and asking investment bankers to rein in their travel expenses. The move comes as outgoing CEO Noel Quinn looks to curb costs at Europe's largest lender. Our deals reporter Manuel Baigori joins us on the line. And Manuel, what's really driving this, do you think, by HSBC?
Hello, good morning. Well, it's just an industry-wide, exercise really to rein in cost, and especially, as you mentioned earlier, with deal making still very sluggish and not picking up, certainly not much at all in Asia Pacific, at least. So we're seeing banks across the board just trying to control cost. We've seen a number of layoffs in the industry over the past 12 to 18 months, and that's perhaps likely to continue as deal making continues to be quite weak. And HSBC, as we note in the story, just has come up with the latest of such measures to rein in cost and kind of like trying to be a little bit more careful with hirings and also trying to be more efficient and more productive. That doesn't mean, as the bank said, that they are obviously prioritizing servicing clients, being more lenient, but at the same time they need to take care and kind of like be careful with cost as well.
Yeah, this has been interesting because HSBC hasn't necessarily taken those extreme measures that we've seen from other banks, right? When it comes to setting up the groundwork for the chief executive, Noel Quinn, to leave and also get a new leader in place, what are some of the other changes that we're seeing?
Yes, you're absolutely right. They're in the process of bringing in a new CEO that should be finalized, we expect finally relatively soon. And then I mean, it's a changing landscape, right? I mean, it's deal making is not as strong or robust as it used to be, and there is lots of unknowns as in when and if it will recover. Particularly here in Asia, is lagging behind the U.S. and Europe substantially. And given the focus on Asia for HSBC, that definitely affects them perhaps even more so than any other bank. So for the new CEO, there will be lots of moving parts, but most importantly, with interest rates also in the horizon, potentially, falling will also have an impact on banks, not just the HSBC, and they will have to adapt to that new reality when that happens.
Deals reporter Manu Bagori there with the latest on HSBC's cost-cutting measures. We have more ahead on the Asia trade. This is Bloomberg.
We are pretty much 50 minutes into trade so far for Aussie assets this morning. You've seen the ASX 200 just pushing a little bit higher here today, led by the gains in tech and mining shares as well. Is that focus, of course, the S&P 500 overnight on Wall Street rising above 5,500 for the first time ever. So a lot of optimism, particularly around the outlook for Fed easing playing out across markets. Yields, you're not really seeing too much movement so far, but we do have some data on the docket. We saw a deterioration in the private PMI reading today. We've also got retail sales plus building approvals numbers coming up later. But let's stick with the property space because South Australia's capital, Adelaide, is considering converting empty office spaces into apartments as it seeks to fend off a housing crisis. But as Paul Allen tells us, the plan is not without its challenges.
The for lease signs are everywhere in Adelaide. The problem is it's the wrong kind of property that's vacant. According to the Property Council, 1 in 5 office buildings sit empty in South Australia's capital, while less than 1 in 100 residential properties are available for rent. That's one of the lowest vacancy rates in the country. These two housemates are in a familiar situation, facing eviction because their landlord wants to convert their home to short-stay accommodation for more money.
He's planning to Airbnb our house out and has only offered us, he's increased our rent and only offered us a 6-month lease.
The solution seems obvious: convert empty offices into apartments, otherwise known as adaptive reuse.
Whilst it's good to have new builds, it seems a terrible waste not to deal with the old property we've got. We've identified another 150 or so buildings that we think have the potential for conversion.
It's an inviting idea, but repurposing these kinds of spaces for living is not as easy as it seems.
The really big challenge is finding the right office building to convert. A building that's got the right floor-to-floor heights, a building that's not too deep and that is slim enough, and a building that's in the right location.
And then there's the matter of finding an investor willing to take on the cost and the risk. Growth is sluggish in Australia, and inflation is still above the Reserve Bank's target band. Not only is it pushing rents higher, it's pushing building costs higher too.
Whether it's improving office stock as is or embarking on what is a huge challenge in adaptive reuse, office to residential, the environment currently in the city isn't one that's conducive to taking on more risk.
Finding cost-effective, elegant solutions to Australia's enduring housing crisis isn't easy.
We'll learn more about Australia's housing squeeze in the next hour when building approvals numbers for May are released. Paula Allen joins us now with more on this. And Paul, we have seen for the longest time this housing squeeze in Australia. What are the building approval numbers going to tell us today?
Well, we are expecting to see a jump of 1.6% for the month of May, but at the same time, I don't think anybody would be shocked if that number misses, because we had a contraction in April. And in fact, if you look at building approvals across the spread of the year so far, they've only expanded 1 month in March. So they have been contracting. And also in May, we had a surprise read on the CPI, jumping up to 4%. And combined with that, we've also got the Reserve Bank of Australia talking about keeping rates, well, higher for longer, and they may actually move higher. The next move could well be up. That hasn't been ruled out as well. So if you take all that together and the cost of building as well, as mentioned there in the package by the Property Council, not too many developers willing to take on risk in that kind of environment. But even if we do get a good buildings approvals number today, that means it's still going to take time before these buildings are actually able to absorb buyers and tenants. So, yeah, it's a long road ahead to solving this problem of the housing crisis.
Yeah, and it could be perhaps a long road ahead for retail sales to get those numbers back into more positive territory. It really seems like it's determined by the RBA as well, Paul.
Yeah, that's right. We will get retail numbers as well at the bottom of the next hour. We're expecting a modest expansion there of 1/3%. But again, taking into account all of those factors I just mentioned, and we are talking about May here, where we got that surprise jump in CPI. Again, I don't think anybody would be too shocked if we undershot on that number. Much like buildings approvals, retail data has been pretty tepid in Australia of late. We heard from the Reserve Bank yesterday in its minutes saying, look, there's real evidence now of financial distress emerging in a number of households. And the Australian Bureau of Statistics, which releases this data set, has also noted that Australians are really cutting back hard on consumer discretionary spending. Things might change in the second half. Of course, this week, everybody in Australia got a tax cut. The easing story does get a little bit more encouraging when you look towards the end of the year. But for now, at least, looks like that data is going to remain on the quiet side.
Paul Allen there joining us from Sydney with the latest on the housing market across Australia. We continue to watch really all of the bond market action given the Treasury yields took a hit after Chair Powell signaled that we are seeing some disinflationary trends in the U.S. So we are now seeing yields across sovereign bonds in Asia following suit, but not for JGBs. The 10-year JGB yield is still above that 1% level. Of course, a whole different story playing out across Japan, where the expectation is for a BOJ rate hike in July. We'll also be watching Chinese bond markets, because take a look at how futures ended the session. What we've been watching in China has been the 10-year yields falling to levels that we've not seen before. They touched record lows on Monday. Where the bond rally goes from here as authorities start to move around this rally will be a question. The China show is next. This is Bloomberg.